Are you looking to start investing in the stock market but don't know where to begin? Are you ready to take control of your investments and start seeing real results? Look no further. In this video, we will be exploring the tried and true methods of legendary mutual fund manager, Peter Lynch. With a 29% annual return and over 13 consecutive years of success managing the Fidelity Magellan Fund, Lynch's approach to stock picking has proven to be highly effective. From the power of compounding to understanding when to sell a stock and where to find opportunities, we will break down Lynch's step-by-step guide for beginners on how to achieve high returns in the stock market. We'll also explore Lynch's PEG ratio and other valuation methods so that you can be confident in your investment decisions. Don't miss out on this opportunity to learn from the best and start achieving success in the stock market. So, sit back, grab a notebook, and get ready to learn from one of the best in the business on how to invest in stocks like a pro. Invest in what you know. Peter Lynch's investment philosophy is rooted in the idea that individual investors have a distinct advantage over Wall Street professionals, specifically when it comes to investing in companies that they are familiar with. He encourages investors to focus on companies and industries that they know and understand, which he believes will give them a better chance of identifying undervalued companies and achieving high returns. There are several advantages to Lynch's approach of investing in what you know. For example, when you understand a company's business model and competitive environment, you can better evaluate the company's true value and long-term growth prospects. Also, by focusing on companies that you are familiar with, you are less likely to be swayed by market noise and hype, allowing you to make more informed investment decisions. To take advantage of Lynch's philosophy, you need to start by using your own knowledge and experience to identify potential investment opportunities. You can do this by thinking about the companies and industries that you come into contact with on a regular basis. For example, you may use a certain product frequently or be familiar with a local business that you think is doing well. From there, you can use the internet and other resources to gather more information on these companies and evaluate their potential as investments. Are you willing to make $1 million from just starting with zero? Then hit that subscribe button and turn on the notifications. I'll take you into steps of making your first $1 million and become financially independent. The power of compounding. One of the key principles of Peter Lynch's investment strategy is the power of compounding. Compounding refers to the process by which an investment's returns generate additional returns over time. The effect of compounding is that the returns on an investment grow exponentially over time, rather than linearly. This is important because it allows even small returns to grow into large amounts over time. For example, if you invest $100 and it generates a 10% return, you now have $110. In the next period, your investment will generate a return on the original $100, as well as the $10 that was generated in the previous period, leading to even greater returns. This process of returns generating returns is the basic mechanism behind compounding. Lynch's investment strategy takes advantage of compounding by focusing on long-term investment strategies, rather than short-term speculation. He believed that by investing in companies that had the potential to grow their earnings at a high rate, the power of compounding would work in his favor. Over time, the returns generated by these companies would compound, leading to even greater returns on the original investment. Real-world examples of the impact of compounding on investment returns can be seen in Lynch's own track record. During his tenure as manager of the Fidelity Magellan Fund, Lynch achieved a 29% annual return, which was significantly higher than the market average. The power of compounding played a major role in these returns, as the high growth potential of the companies in his portfolio generated returns that compounded over time. For example, if an investor had invested $1,000 in the Magellan Fund in 1977, it would be worth $28,000 by the time Lynch retired in 1990. This is a testament of how powerful the compounding effect can be in driving investment returns. Additionally, Lynch's approach of holding onto stocks for long periods of time can maximize the potential of these returns, allowing investors to achieve even higher returns over time. Researching stocks. Peter Lynch's investment strategy is based on a bottom-up approach to stock picking, which means selecting stocks one by one and thoroughly researching each company before making an investment decision. This approach is based on the belief that individual investors can have a distinct advantage over Wall Street and large money managers by investing in companies they are familiar with and understand. To conduct fundamental analysis on a company, Lynch suggests investors start by examining the company's financial statements and key financial metrics such as the current ratio, debt-to-equity ratio, and earnings growth. This will provide insight into the company's financial health and its ability to generate profits and grow in the future. Lynch also emphasizes the importance of understanding a company's business model and its competitive environment. Investors should research the company's products or services, target market, revenue streams, and customers. Understanding these factors can help investors to identify companies with strong growth prospects and a sustainable competitive advantage. To achieve a thorough research, Lynch also advises investors to read analyst reports, industry reports, and news articles about the company, its products, and its industry. Furthermore, investors should be aware of the company's management team, their track records, and any new trends or disruptions that can change the way the company operates. If you want to live the life you've been craving, then press the subscribe button and turn on the notification bell. The importance of understanding financial statements. Peter Lynch emphasizes the importance of understanding a company's financial statements, particularly the balance sheet, when making investment decisions. A balance sheet provides a snapshot of a company's financial position at a specific point in time and gives insight into the company's assets, liabilities, and equity. To analyze a balance sheet, Lynch suggests looking at key financial ratios such as the current ratio, which measures a company's liquidity, and the debt-to-equity ratio, which measures a company's leverage. By comparing these ratios to industry averages, an investor can get a sense of a company's financial health and its ability to meet short-term and long-term debt obligations. Apart from using the balance sheet, Lynch also advises investors to pay attention to other financial statements such as the income statement and cash flow statement. These statements provide information on a company's revenue, expenses, and net income, and give insight into the company's profitability and growth potential. By analyzing these statements, an investor can make informed decisions about the company's financial performance and future prospects. PEG ratio and other valuation methods. The PEG ratio is a valuation metric that was popularized by Peter Lynch, and it helps investors determine whether a stock is inexpensive given its growth potential. The PEG ratio is calculated by dividing the price-to-earnings ratio P by the company's projected earnings growth rate. A PEG ratio of less than 1 indicates that the stock is undervalued, while a ratio greater than 1 indicates that the stock is overvalued. Lynch believes that PEG ratio is a simple yet powerful tool that can help investors find undervalued companies with strong growth prospects. Along with the PEG ratio, Lynch also uses other valuation methods to identify undervalued companies. He looks at the price-to-earnings ratio P and price-to-book ratio PB and compares them to industry averages. He also focuses on a company's historical trends, such as their revenue and earnings growth, cash flow, and other financial indicators. Another key aspect in Lynch's approach is to pay attention to a company's management and the quality of management team. This can give insights into the company's future performance and the management's approach to shareholder value. By using a combination of these methods, Lynch believes that individual investors can identify undervalued companies with strong growth prospects and make informed investment decisions. When to sell a stock? According to Peter Lynch, one of the most important aspects of investing in the stock market is knowing when to sell a stock. He believes that investors should have a clear strategy for determining when it's time to sell a stock in order to avoid potential losses. Lynch also believes that investors should not hold onto a stock simply because they bought it. Instead, they should actively monitor their portfolio and sell stocks when they no longer meet the criteria that were used to justify buying them in the first place. Lynch has a set of criteria that he uses to determine when a stock has become overvalued or is underperforming. These include changes in the company's business, industry, or market conditions, changes in the company's financial performance, and changes in the company's valuation relative to its peers. When a stock no longer meets these criteria, Lynch suggests that it may be time to sell. Another important aspect of Lynch's approach is determining the right time to sell a stock. Lynch suggests that investors should be patient and not make hasty decisions, but also be disciplined and not hold on to a losing stock for too long. By regularly monitoring their portfolio, investors can identify when a stock is no longer meeting their investment criteria and make a decision to sell. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.